Know these 5 things before you invest in mutual funds. Don't fall under traditional myths. 1. NAV. New investors are preferring lower NAV funds. It is a misunderstanding. NAV is the price for an unit according to the fund and portfolio. It is like an asset price per unit. X. Let us take example of 2 funds where Fund 1 has a NAV of 20 rupees and Fund 2 has a NAV of Rs. 0.50. If you invest 10,000 rupees, you will get 500 units from Fund 1 and 200 units from Fund 2. But your investment value remains the same as Rs. 0.1000. One should have clear understanding about the same, so because of choosing lower NAV funds you may not get better returns. So don't believe in the myth of lower NAV funds has better chance to perform. 2. Past performance. Most of the investors are deciding based on the past performance of the funds whether to invest or not. But please remember that past performance of the fund is not an indicator or guarantee for future performance. It is not bad to know the fund performance at different intervals, but don't make decisions only based on that. Compare with benchmark, peers, etc. and take a wise decision. There are many other critical factors to be considered. So, don't believe the myth of past performance is guaranteed for future performance. 3. Dividend. Most of the investors are considering dividend as one part of their income. New investors are preferring dividend option and they are happy with it. Even some of the distributors also believes it. One needs to understand that dividends are paid from the AUM, means it's the investor's money. After the dividend, NAV of the funds is also reduced. Remember that dividends are calculated from the face NAV value of the funds, not from the current NAV. For an example, current NAV of the fund is 50 rupees and dividend of 50% from that fund. The investor will get 5 rupees as dividend from the face value of 10 rupees and not from the current NAV. 4. Never stop your SIP during downtrends and never try to time the market. Up and down are casual routine in stock markets. You cannot time the market. So never stop your SIPs during downtrends. Ideal time for a SIP to perform is 5 to 7 years. New investors are stopping the SIP after seeing their portfolio is down or negative. Remember, don't believe the myth of timing the market. No one can do that. To get better return you have to spend more time in the market. 5. Know the objective and strategy of the fund. Most of the investors do not even bother to read the objective of funds. One should understand the objective and strategy of the fund. Objective of the fund will clearly explain their pattern of investments and how they are going to invest to get returns. Most of the investors are making this mistake of not understanding the fund objective, so understand the fund objective and align your investment accordingly. Please like, share, subscribe our channel to know more about personal finance.